Hello everyone. Good afternoon. This is Dr. Sonali Sajjan, Assistant Professor, Department of BCA, IIMT College of Management, Greater Noida. Today I am going to explain about the topic, and the topic is accounting principle, concept, and accounting convention. Let's have a start. Before going to the accounting concept, first we have to know about accounting principle. Accounting principles are the set of rules of action or conduct adopted by accountants universally while recording accounting transactions. They are the norms or rules which are followed in giving accounting treatment to various items of assets, liabilities, expenses, and income. Accounting principles are a set of guidelines and rules issued by accounting standard like GAAP, GAAP, generally accepted accounting principles for the companies to follow while presenting or recording financial transactions in the books of accounts. This enables companies to present a true and fair view of the financial statements. Accounting principles can be categorized into two parts, that is, accounting concepts. The terms accounting concepts refers to basic rules, assumptions, and principles which act as a primary standard for recording business transactions and maintaining books of accounts. It is a kind of rules and regulations which have to follow each and every accounting businessman and entrepreneur and proprietor. There are some objective of accounting concept, that is, maintain uniformity and regularity in the preparation of accounting statement. Accounting concept as an underlying principles that helps accounted in the preparations and maintain of business records. The main objective of accounting concept is that to understand the business rules and regulations that are required to be followed by all types of business entities. There are some different accounting concepts. These are going concept, consistency concept, accrual concept, business entity concept, money measurement concept, accounting period concept, cost concept or historical concept, dual respect concept, revenue recognition concept or realization concept, matching concept, and objectivity concept. These are 11 different types of concept, which is also known as assumptions. We will briefly describe one by one in next PPT. Going concept. Going concept in accounting states that a business activities will be carried by any firm or an unlimited durations. This simply means that every business has a continuity of a life. Hence, it will not be dissolved shortly. For example, the plants and machinery was purchased by a company for 10 lakhs and its lifespan is 10 years. According to the going concept, every year some amount of assets purchased by the business will be represented as an expenses and balance amount will be shown as an assets in the books of account. One of the best example of going concept can be a loan, which is given by the bank for long period of time, that is 10 years, 25 years as well. Consistency concept. Under this concept, it means that same accounting principles should be used for preparing financial statement year after year. A meaningful conclusions can be drawn from financial statements of the same enterprise when there is a comparison between them over a period of time. Consistency concept, it means like the person or the business or enterprises, if the business or enterprises uses the depreciation method, that is a straight line method, then he have to be continued for the next year. Suppose a business use depreciation from a straight line method in 2015. And 2016, if we change their method, weighted method in depreciation, then it is very difficult to know the appropriate amount of profit or loss. Accrual concept. The accrual concept tells that the business revenue is realized at the time goods and services are sold, irrespective of the fact when cash is received for the sale. The transaction is recorded in the books of accounts of a time when it is entered into the, not when in the settlement takes place. For example, on March 5th, 2021, the firm sold goods for 5,000 and the payment was not received until 5th April 2021. The amount was due and payable to the firm the date goods and services were sold, that is 5th March 2021. It must be included in the revenue for the year ending March 31st, that is 31st, 2020. Next one is business entity concept. Under this concept, the business entity, economic entity, or separate entity concept assume that a business is independent of its owner. The business entity concept states that the business and the business owner are two separate or distinct persons. Accordingly, any expenses incurred by the owner for himself or his family from business will be considered as expenses and it will be represented as drawing. Money measurement concept. Money measurement concept assumes that the business transactions are made in terms of money, that is in the currency of a country. For example, the sale of goods worth rupees 1,000, purchase of raw material 5,000, rent paid 2,000 are expressed in the term of money. Hence, these transactions can be recorded in the books of accounts. But a union strike is not, it is a very mandatory or important thing for management point of view, but it is not a financial point of view because we cannot measure into the money, so it will be not recorded in the book of account. Accounting period concept. This concept states that all the transactions recorded in the books of account should be based on the assumptions that profit on this transaction is to be ascertained for a specific period. The year that begin on January 1st and ends of January 1st, 31st is termed as calendar year, where the year that begins on April 1st and ends on 31st March termed as financial year. Cost concept or historical concept. The accounting cost concept states all the business assets should be written down in the book of accounts at the price assets and are purchased, including the cost of acquisitions and installations. The assets are not recorded in their market price. For example, a machine was purchased by ABC Private Limited for rupees 10 lakh are manufacturing bottles. An amount of 2,000 were spent on transporting the machines to the factory site. Also, 2,000 was additionally spent on its installation. Hence, the total amount at which the machine will be recorded in the books of account will be the total of these items, that is 10 lakh 4,000. This cost is also termed as historical cost because these expenses was happened on the past. Dual aspect concept. The dual aspect is the basic principle of accounting. It provides the basis for recording business transactions in the books of accounts. This implies that the transactions that is recorded affect two accounts on their respective opposite sides. Hence, the transactions should be recorded at the dual places. For example, goods purchased in exchange for cash have two aspects, such as paying cash and receiving goods. Therefore, both aspects should be registered in the books of accounts. The duality of the transaction is commonly expressed in the term of the following equation that is given below. It means asset is equal to liabilities plus capital. If we wanted to know the capital, it means assets plus liabilities is equal to capital. The dual concept implies that every transaction has a similar effect on assets and liabilities in such a way that the value of total assets is always equal to the value of total liabilities. Next concept or assumption is revenue realization concept. The term realization concept states that revenue earned from any business transaction should be included in the accounting records only when it is realized. In other words, the revenue concept states that revenue is realized when cash is received or the right to receive cash on the sales of a goods or services or both have been created. It means there is a three phases. Suppose a company get ordered a goods on 1st January and it is shipped by 15th January and the ownership transferred on 30 January and the cash received by 5th February. It means the transactions have to be mentioned from the 31st January on which date the ownership has been transferred. Not even the cash or services received or not, it doesn't matter. We have to be revenue realized on that day when the transfer of ownership. Next is matching concept. The matching concept states that revenue and expenses incurred to earn the revenue must belong to the same accounting period. For example, if you pay a commissions to a salesperson for the sales that you record in March, the commissions would also be recorded in the same month. The matching concept implies that all the revenues earned during an accounting year, whether received or not during that year or the expenses incurred whether paid or not during that year should be considered while determining the profit and loss of the business for that year. Last concept assumption is objectivity concept. Under this concept, it is mentioned there that the financial statement of an organization be based on the solid evidence. The intent behind this principle is to keep the management team and accounting department of entity from producing financial statements that are slanted by their opinions and biasness. This concept is to avoid the biasness from the proprietor as well as the accountant. My next topic is accounting conventions. An accounting conventions refers to a common practices which are universally followed in the recording and presenting accounting information of the business entity. Conventions denote customs or traditions or uses which are used since long. To be clear, these are nothing but unwritten laws. The content have to be adopt the uses or custom which are used as a guide in the preparation of accounting reports and statements. These conventions are also known as doctrine. So there are some types of accounting conventions, which is conventions of full disclosure, conventions of conservatism, conventions of materiality. Let's go ahead for briefly description. Conventions disclosure. Conventions of full disclosure require that all material and relevant facts concerning financial statements should be fully disclosed. Full disclosure means that there should be full, fair, and adequate disclosure of accounting information. It doesn't mean that the company have to disclose all the planning and secrets to the entire thing. It means that the stakeholders items or the informations related accounting related informations, they have to be disclosed in the footnotes. Conventions conservatism. This convention is based on the principles that anticipated no profit but provide for all possible losses. It provides guidance for recording transactions in the books of accounts. It is based on the policy of playing safe in regarding to showing profit. The main objective of this convention is to show minimum profit. Convention of materiality. The convention of materiality states that to make financial statements meaningful, Only material fact that is important and relevant information should be supplied to the users of accounting informations. These are the topics we have discussed and about accounting principles, accounting concepts, and accounting conventions. Accounting concepts are that are not changed, that are uniform in nature, but accounting conventions can be changed or updated according to the requirement. So thank you for watching me live. Thank you.